Good morning, ladies and gentlemen. I'd like to welcome you to the Altron Interim financial results for the 6 months ended 31 August 2021. My name is Thabiso Hermanus. I'm a finance executive at Altron, and I have the pleasure of being your MC this morning. I trust this session this morning will be both informative and assuring regarding the performance and outlook of the group. Our program this morning will be presented in 4 parts. To begin will be our Chief Executive, Mteto Nyati, who will give a welcome and an overview of our performance. He will then be followed by Nicholas Bofilatos, Group CFO, who will present the financial results. And to close out the presentation after that, Mteto will come back to give the outlook. The fourth and final part of the session after the outlook will be our questions and answer session, which you will form an integral part of. I would like to please encourage you to type in your questions in the chat box. Without further ado, ladies and gentlemen, I would like to hand over to Mteto Nyati.
Thank you, Thabiso. Good morning, ladies and gentlemen. I would also like to welcome you to our interim results presentation for FY22. A special welcome to our new chairman, Stuart van Graan, who took over from Mike Leeming. As you know, Mike ably guided this organization for 4 years. We have no doubt that Stuart will show stewardship. Another special welcome to the members of our board who continue to constructively be engaged as we navigate uncharted territories. It would be remiss of me if I did not also welcome our managing directors and our group executives. Every day, they go out of their way to lead their operations in fulfilling our mission of delivering innovation that matters. The need for innovation that makes a difference has never been more relevant than it is right now. Our customers are facing a challenging economic environment coupled with a never-ending COVID-19 pandemic. They are opting to do more with less. Who can blame them? Naturally, they are sweating their assets. It is in this environment that we are seeing our managing directors, together with their operations, assuming the role of trusted advisors to their customers. The resilient performance that we will share with you demonstrate how relevant we have become to our customers during these tough times. Talking about results, I would like to provide an overview of the business. I will begin at an Altron Group level. In the first half, we delivered 4.6 billion rands of revenue, representing a growth of 5% year-on-year. Our net debt to EBITDA is 0.25 times. As many of you know, we declared a special dividend of 96 cents at the back of Bytes UK demerger. Going now to our continued operations. We referred to our continued operations as Altron 2.0. Altron 2.0 delivered 3.5 billion rands of revenue, representing a growth of 2% year-on-year. The operation that had our top-line growth was Altron Systems Integration, whose revenue declined 17% year-on-year. Headline earnings per share is at 11 cents, up 238% year-on-year. As a leadership team, we had a strong focus on working capital management, and this focus paid off. We saw a release of 347 million. Our board has subsequently approved a dividend of 7 cents per share. I would like now to move to our highlights and challenges that we encountered in the first half. We had already indicated that We would like to have a lean head office, and we executed on this in the first half. We have reduced our headcount in the head office by 36%, and we've also flattened the organization. We are forecasting to close the year with a head office cost of less than 150 million. Some of you may remember this amount was 235 million last year. Our Netstar operation achieved a milestone of 1 million subscribers. This represents a growth of 18% year on year. We are encouraged by this. What is encouraging us even more is the strong performance of Netstar Australia. For the second reporting period, they have come out with very strong results. In this reporting period, the revenue from Australia was up 37%, and the operating income up 46%. Our problem child, Altron Carabiner, we are really excited to see the turnaround in this business at the back of the management changes that we made at the beginning of the year. The revenue was up 47% and operating income up over 100%. But for me, what is more important is the amount of business that was signed in the first half. We signed 196 million rand. And this shows how healthy things are going to be as we go forward. And the amount of business that we signed was up 76%, which means we are focused, we are relevant to our customers, and we're able to close those businesses in the Carabiner space. Yes, I've already indicated that we had challenges in systems integration. The big challenge here is that, if we're honest, we were very slow in transitioning this business into high-value services. So what we did is that we spent the first quarter right-sizing the business and also aligning it to the growth areas of data, of cloud, automation, and also DevOps. We faced a significant amount of competition for our talent. Many of our operations that are operating in the high growth spaces, operations like Carabiner, like security, systems integration, and also our fintech, experienced this challenge. So we had to make some changes within our business in order for us to retain our key talent. And of course, COVID-19 continues to have a negative impact on our business, in particular around global supply chain. And we also saw a number of key sectors in the market reducing their capex. We had to make sure that our business is flexible and is also agile. And we did this by reducing the head office headcount and delayering head office, and that has helped us to be tightly connected with our operations. And that helps us to be able to connect and respond quite quickly to the changes that we are seeing in the market. What are some of those changes? We saw that in the systems integration space, we had to simplify the business, right-size it, and we did that. Our managed solutions business experienced big challenges when it comes to ATMs. And it was at the back of the costs that we saw coming in from our NCR partner. These are costs called PDS costs, the Partner Developed Services costs that we have to pay a license for. To try and address those challenges, we had to respond, and we indeed respond. And you can see in the graph on the right-hand side that the first quarter for these two businesses, it was a big challenge. And they were able to turn around in the second quarter after we've made some of those changes. And this is the trend that we'll continue to see as we move this business forward. COVID-19, although it had a huge negative impact around the global supply chain, we saw that the working capital, through the focus that we have, we're able to realize a positive outcome there. The electronic components in particular hurt our business, the Netstar. If you look at the top line growth in that business, it's about 8%. It's something, of course, it is in line with the guidance that we have given to the market, but when we see the demand that we have there, we could have been able to deliver double-digit revenue growth within Netstar, except for the fact that we had these challenges around electronic components. But the business that benefited the most out of the shortage of components was Altron Arrow. They shot the lights out in almost all of the key metrics, whichever way you want to look at it, that businesses have done exceptionally well in the first half. We saw also the drive towards hybrid work. We had to respond quickly to these changes. We implemented a new hybrid policy within our group and rolled it out within Altron. And the timing was also perfect because we moved into our new Altron campus. And the campus, its design point was to make sure that we cater for only 60% of our workforce. And this talks to the new operating environment of hybrid work. Employee well-being, yes, here, and many of our employees are facing some challenges. We had to respond here by having sessions that deal with mental issues, mental well-being, spiritual well-being, financial well-being. That is an agile company. That is what we had to do, and we did that. We executed our strategy, of course. That is what we are here for. And the key areas that were very important for us was to make sure that we drive the disposals. We have already communicated to the market that we sold our Altron People Solutions to ISON and LRMG. On the last Friday, we received a binding offer for Altron Document Solutions. We see over the next month and a half where we'll be concluding that sale agreement with this potential buyer. Arrow, we are in the beginning stages. We received a new interest, and we are engaging with this new buyer there. Many of you would know that we did an acquisition of LawTrust, and it fits into our areas of focus of high security. They've got high annuity business, and they've got great intellectual property. So we're excited, truly excited about that business. Netstar. In Netstar, our big focus for us in the first half was to make sure that we address the operational issues that were impacting this business. And these issues were ending up having a high churn rate in the business. So the big focus that we had was to make sure that we look at all of those areas where we can leverage and address issues that talk to customer experience. Things like the customer response times, things like abandonment rate, things like how long does it take to take a lead from a lead to a contract? How long does it take for us to take that contract and to fit a device into a car of a customer? All of these matrices, these are key into helping us to differentiate ourselves in a market that is a bit loose when it comes to customer experience. We want to set ourselves apart in this space, and we've done a great job, and it is starting to pay off. We're starting to see consistently month after month putting positive subscribers that we are adding into this business. Absolutely critical when we think about the long-term plans where we want to be in this business in FY25. Now talking and moving into our segments. Here, I'm just going to be broadly going back to what we communicated during our Capital Markets Day. Our expectation of this segment is that it should be delivering top line and bottom line mid-single-digit growth, What we see here is that the results of this segment are consistent or better than that guidance that we gave you. So we are particularly excited about this, and we think we can even do more, in particular in NetStar, as we execute on the changes that we are making in that business. In the digital transformation segment, again, taking you back to the communication that we made and our commitment that this segment should be growing top line and bottom line double digit. Here, there are two businesses that have done that: Altron Carabiner and Altron Security. The business that have really hurt us is systems integration, and I've already indicated to you the problem is that we were late, we were slow in adjusting this business and aligning it to the growth areas, and it is a business that was top heavy. We had to make those tough calls in the first quarter of this financial year. The managed services space, this is here we have struggled. This is the business that was hit the most by COVID-19. It was hit the most by the global supply chain. This is a business that is also delivering, yes, looking at it, top line growth of 1%. And we said that this business should grow in line with CPI. In this case, it's about 3 or 4%, so it is below that. It's a business that requires a lot of attention, and we've done what we needed to do to make sure our banking unit, the NCR part of managed solutions, is able to be profitable. To conclude my section, I want to go back to some of the priorities that we have shared with you at the end of the last financial year. The first one was around the disposals. Yes, we have done the disposal of People Solutions. We have also made sure that we are in advanced stages when it comes to Altron Document Solutions. Here, where we are behind is in the Arrow disposal. Arrow, we are behind, but what is important is that the leadership team in that business has made sure that we look after the business and we make sure that the business continues to deliver in line with expectations. At this time, we're delivering better than expectations. We have done the expansion to the UK when it comes to Altron Security, and we have also integrated, or in the process of integrating, Law Trust into our business. Our head office costs have come down. We've done the execution there. Carabiner has turned around. The problem area, the area where we are focusing on as management, is to make sure that we help realize the potential of systems integration. Here, it is here that I would like to hand over to our CFO, Nicholas, who is going to take us through the numbers. Nicholas.
Thank you, Mteto. I'd like to take this opportunity to talk you through what has changed within our business since our year end that has impacted our financial landscape. This time last year, Bytes UK still formed part of our continued operations and was reported as such in our interim results. By year end, we had completed the very successful demerger and separate listing of Bytes UK, which resulted in the operation being classified as discontinued from the date of disposal. During the first half of the financial year, management had taken the decision to disinvest from our African operation, and therefore Altron Rest of Africa, the segment, has been classified as held for sale within our interim results. During the interim period, Altron terminated its agreement with AIMS and waived its BEE vendor loan to the value of 47 million rand, which included Altron being released of certain financial guarantees. A resulting consequence of Bytes UK and the demerger was the impact it had on our long-term incentive share plan. The revaluation of the Altron share post-demerger rendered our entire long-term incentive share plan irrelevant and underwater. Through the circular announcing the Bytes transaction, we made reference to the need to modify our share plans to compensate and return our participants into the same position that they would have been in before the demerger. This modification is directly linked to the Bytes UK demerger and has resulted in an additional share-based payment expense to the tune of 59 million rand for the full financial year. When unpacking this number further, 46 million of this cost is attributable to the first 6 months of the year, of which 31 million pertains to the continued operations. As a benefit to our results, we recorded a 22 million rand uplift by adjusting for future forfeitures resulting from non-market performance conditions such as the exit of some senior employees. As Mteto alluded to earlier, both Altron Managed Solutions and Altron System Integration underwent restructurings to realign and right-size the businesses. This has resulted in an 11 million severance cost within H1, with a further expected 3.5 million within H2. The combined month-on-month saving on a go-forward basis is estimated to be around 6 million per month, which will further benefit our second half of the year. The continuing operations recorded operating income of 173 million. This is a 70% improvement against the prior year. However, last year isn't the strongest period to compare one's results to. So on measurements against pre-COVID norms, it achieved a 37% growth against August 2019. If we're able to take a step back and ask ourselves, what did the core business really achieve through its day-to-day operations? We would need to consider the financial impacts I highlighted in the previous slide. When we pull out the negative impact of the modified share-based payments directly linked to the Bytes UK demerger, as well as the positive adjustment made on the future forfeits, we end up with a 9 million adjustment that doesn't relate to the true operational performance. To further normalize for the once-off severance costs, we would adjust for the 11 million, and this would represent the continuing operations' true operational performance being 193 million for the period. This is an 84% improvement against the prior period on a normalized basis. Through several cost-saving initiatives, the continuing business achieved an operating cost margin of 32.1% when expressed over gross invoiced income. This is a 280 basis point reduction against the prior year. Once again, assessing against pre-COVID norms, the operating cost margin is reduced by 210 basis points. On normalizing for the share-based payments and severance costs I discussed earlier, the normalized operating cost margin for the core business is 31.6%, and this is a 320 basis point improvement against the prior year. When we look at headline earnings, the 40 million is not a true representation of what our continuing business has achieved in the first 6 months of the financial year. This waterfall graph depicts the material impact on the headline earnings and bridges the 40 million, which we report, to what we believe the true operations achieved within this period. When understanding the once-off impact of the AIMS loss, the nature of the additional share-based payments expense, and the removal of the benefit we received as a result of the future forfeits, the severance costs, and all net of tax, the continuing operations achieved a normalized headline earnings of 101 million. Before we work through the detail of the continuing operations summarized income statement, I would like to reiterate the changes since our interim reporting in the prior year. The major change is, in our interim results last year, the Bytes UK results still form part of our continuing operations. Since Bytes UK has been demerged, the results of its operations up to the demerger date have been classified within our discontinued operations, and therefore the comparatives have also been restated accordingly. Therefore, these results reflected in this income statement are on a like-for-like basis. Although statutory revenue remains relatively flat year on year with a 2% growth, we have normalized for the impact of gross invoice income, which is driven by Altron Caribbean and Altron Security. Just to remind everyone, despite it not being as material since the demerger of Bytes UK, the correct way to look at our revenue should be on a gross invoice income basis, as this is what drives our margins and working capital. Operating income of 193 million on a normalized basis is up 84% year on year. Our net interest expenses have benefited from lower debt levels, which we were able to reduce with the proceeds from the Bytes UK demerger and maintain thereafter. As touched on in the previous slide, our normalized headline earnings has grown in excess of 450% against the prior year. And an interim dividend of 7 cents per share has been declared by the board, which follows from the special dividend of 96 cents that was paid in the month of May. I must highlight that the dividend of 33 cents declared in the comparative period was based on continued headline earnings, which included the profits of Bytes UK for the full 6 months, and therefore is not representative of the restated comparative results reflected here. At our interim results last year, we reported working capital of just under 1.5 billion. However, Bytes UK had a negative working capital cycle, and on removing the impact of Bytes, the group rebased working capital for the comparative period would have been closer to the 2.1 billion mark. On a like-for-like basis, we have reduced working capital by 446 million during the last 12 months and have continued to further release working capital from our year-end results to the tune of 80 million over the first 6 months. This illustrates management's drive to become a capital-light business as per the Altron 2.0 strategy. An item to note is that within our working capital balance of 1.6 billion, there is almost 800 million relating to operations held for sale, and therefore we have every expectation to reduce this 1.6 billion balance by a further 50% post completing the disposal transactions. Subsequent to our interim results, this balance has already reduced by over 50 million in working capital associated to the Altron People Solutions sale. When we start with our reported cash balance from the year-end results, we will need to understand that we held 355 million within our cash pertaining to the special dividend that was paid out in May, which therefore inflates our base for the financial year. So once we exclude the cash associated to the special dividend, we rebase our cash balance for the start of the financial year to a 376 million. From that point, our cash generated from operations was 447 million. And as discussed on the prior slide, there has been a release in working capital from the group of 80 million. Included in investing activities is investment in PPE of 104 million, which contains the final capex spend of 63 million in completing the new Altron campus and warehouse. 86 million was invested in capital rental devices in Netstar, and the remainder mainly relates to the deferred purchase price paid for our Altron Carabiner and Altron Security acquisitions. Within financing activities, we have our lease payments linked to our right of use lease liabilities as per IFRS 16, as well as the financing on the Altron Document Solution lease book, which the back-to-back receipts are accounted within the cash generated from operations. We have seen a significant reduction in net debt during the last 12 months, largely attributable to funds received in respect of the Bytes UK demerger via our treasury shares. The 0.25 times net debt to EBITDA is below our long-term guidance of 1. And with the acquisition of Law Trust being effective 1 October, the net debt to EBITDA multiple after taking into account the first 2 tranches of the purchase price would adjust it to a 0.4 times multiple. We continue to have a strong and healthy balance sheet, which places us in a good, agile position to act on potential investments which arise that meet our investment hurdles of being within our identified growth areas of cloud, data, DevOps, and security, that have high annuity revenues, own their own IP, and are capital light. With that, I'd like to hand you back to Mteto, who will take us through the outlook section of our presentation. Thank you.
Thank you, Nicholas. I want to, before I go to the outlook, just to go back to the Altron 2.0 strategy and just touch on a few points there. The first one is, if you can see that at the center of our strategy is our values. We are a values-driven company. As we go through many of these challenges, whether it's COVID-19, it's the economic environment, on many issues like the well-being of our employees, the things that help us, that guides us to make decisions, these tough decisions, are these values. They help us to be consistent. They help us to make sure that we do the right things right. Here, when we look at things like the big issue of should we be going the mandatory vaccination route or not, this is a big question many companies are facing. And for us, it was not that difficult because it's something that is also guided by our values. Our values are saying we need to embrace diversity. We need to make sure that there's inclusion within our company. So as we were battling with that decision, these values helped us and guided us and make sure that we continue to stand for choice within our company, but strongly encouraging our employees to vaccinate themselves. So that is the current position that we have taken within the company. We also, as a company, took a very big goal, bold goal, a goal of tripling the operating income in 5 years. The base for this is 342 million of operating income. We are only 6 months into this 5-year plan, and we remain committed to making sure that with triple operating income in 5 years. That is the big focus. Our acquisition strategy, the cross-selling that we do within our business, everything is focused on making sure that we deliver on this. Yes, it's a big goal. It's a challenging goal that we have set for ourselves, but it's something that we also believe that it is achievable. In terms of the priorities that we have for the second half, it is absolutely critical for us to make sure that there is a successful integration of LawTrust. This is a business that comes with a very strong intellectual property. It's something that we can be able to take into other markets, and something that the IP we can also be able to license with other players globally. This business, we've got such a huge potential. But it all starts with having a successful integration of this business into Altron. The second priority is the disposal of our document solutions. And as you know, we have already indicated that we have received a binding offer. In the next 1.5 months, we want to make sure that we conclude this sale agreement. The second priority there also is make sure that we exit properly in the rest of Africa. The third priority that we have is the finalization of the City of Tshwane discussions. We are looking at the best way of moving forward with the City of Tshwane. Our discussions currently are at an advanced but sensitive stage. As we are part and parcel of a consortium, we are not at liberty at this time to be sharing, but as soon as we conclude those discussions, it is something that we will be communicating to the rest of the market. The fourth priority that we have, we are excited about Carabina turning around, but we believe that the potential of this business is still huge. It's a business, if you look at the results of Microsoft, consistent growth. Yes, we are growing faster than Microsoft, but we are coming from a low base. We have to just consistently be doing that over the next reporting period, the next financial year, and continue to go on and on, because this is a space that is a high growth space. It's a space where many of our customers are looking at their ERP and CRM and saying they would like to be moving more into the Microsoft environment. Who are the best implementers than us to capture that? We have set ourselves as being the trusted advisors to our customers. So this is a space that we cannot afford not to capture. So the acceleration of growth in Altron Carabina is critical. The final priority that we have for this H2 is the building and qualifying of acquisition pipeline. It is important that we strengthen and continue to build our digital transformation segment. This is the heart of Altron 2.0. This is where we are helping our customers to digitally transform. It is a space where we cannot afford not to have capabilities that are missing. This is where we are looking, where we've got gaps, and are looking to make sure that we bring those capabilities into Altron. My final slide is really around the outlook that we have. In terms of our operating income for H2, we have no doubt that we would be able to deliver above 2 times that one of H1. This is something that is consistent with how we have always done in the past. This is how our business looks like. A big hockey stick, yes, but that's just how our business is. In terms of the operating income, at a minimum, we're expecting it to grow at 30%. So with that, I would like us now to hand over to Thabiso, who will facilitate our Q&A. Thabiso, over to you.
Thank you, Nicholas and Teto. We'll now move to our questions and answers. Please provide progress on Netstar getting to 2.5 million subscribers by FY25, and is this still possible?
Thanks, Thabiso. We do think this is an achievable target. With us hitting 1 million subscribers this year and the digital transformation program, we've seen significant operational improvement, which will lead to higher lead conversion and improved customer experience. We expect organic growth to be driven by new products and solutions offered to the market, but also really building on our international distributorship with potential future acquisitions. And this is how we see ourselves achieving the target.
Thank you. Next one. Is there a threat to Altron managed services with all the hyperscale data center being developed in SA? Vintage, Terraco, AWS, Microsoft are prime examples.
I will take that question, Thabiso. Because we mentioned that we are in the cloud space, there's often a misunderstanding that we probably are competing with these hyperscalers like AWS, Microsoft, Terraco. In reality, we are not competing with them. In fact, they are our partners. Altron Carabiner is a big partner of Microsoft when it comes to Azure. We help our customers move to Dynamics 365 that is sitting in the Azure database of Microsoft. The same as systems integration is a strong partner of Terraco and also of AWS. So the more of these hyperscalers get into South Africa, the better, because what it does, it offers our customers choice. It also drives down the costs of moving into the cloud. And it also, because many of our customers are continuing to struggle with moving data out of South Africa due to data privacy issues. So the more there are these investments into our country, it is something that is good for our customers, it is good for us as the service providers or systems integrators, and it's also good for the cloud providers.
Thank you. With the sale of People Solutions and hopefully imminent sale of Document Solutions and Arrow, has Altron identified a target offshore acquisition with the proceeds of these 3 disposals, 800 million and City of Tshwane, 300 million?
So I would also take that question, Thabiso. As I've already indicated in my presentation, our focus for the second half is the one of building and qualifying acquisition targets. This is something that we have always been doing. It's something that we will continue to do. Our 2 areas where we believe we should be making acquisitions is in the digital transformation space and in the own platform space. And these are the areas where they will require huge element of intellectual property, and most of those, there's capital-light business and high annuity business. So these are the areas that excite us, and this is the area where we will be deploying most of the funds that we have as soon as we have targets that meet our criteria in terms of investment.
With regard to revenue and operating income, how big is annuity-based income, and at what growth rates does management expect annuity-based income to grow?
You can take that, Nicholas.
Thanks, Mteto. Annuity-based income is really a blend across all operations. We have some operations that are traditionally a higher blend of annuity, and others like an Altron Arrow that has really low annuity income. On a blend basis, I would say we're comfortably around 60% or in excess of that as a group. The growth rates applied to that would again differ depending on what segment we're talking at, but I would imagine that our growth rate would be in excess of 10% on our annuity base.
Thank you. Does Altron have any regrets in selling off all their interests in Bytes given its current market valuation, sweet spot in digitization, proven and intricacy known businesses, and now having to source another offshore acquisition? Example, Investec retained a 25% interest in 91 when they spun off this business last year.
Look, Altron, we do not have any regrets. And what we did was the right thing. We believe as a company that each and every one of our operations should realize their true potential. Some of them may realize their true potential within Altron, and that is okay. And some of them we may decide, like in terms of the disposal, that these are good assets, but these assets, we are not the best people to be running those assets. Somebody else should be, so we'll dispose of those. And in some cases, we may decide that no, these assets need to be, like we have done with the demerger of Bytes UK, they are best outside of our company for them to realize their full potential. At the core of what we do is to make sure that we're doing what is right for our shareholders and what is right for our customers. And we believe what we did with Bytes UK was the right thing for our shareholders. It was also the right thing for that operation to realize its full potential. Through the proceeds that we got out of Bytes UK, we've been able to reduce significantly our levels of debt, and that positions us well to be able to make acquisitions in the areas that are very much in line with Altron 2.0. So we are excited about the outcome of Bytes UK demerger and what the results of that was to Altron and what it has set us to be able to do going forward for Altron 2.0.
Thank you. Are you still confident in the operating profit targets that you provided in 2021 year end? Do you have an update growth targets?
Want to take that, Nicholas?
I think we maintain the growth targets that we communicated to the market at FY2021 year end. Mteto has alluded to the challenges we've had within our systems integration business within the first half of the year, but we have every expectation to deliver on our H2 performance and capture as much of that growth as we've put out to the market.
When is Altron's leverage position likely to be closer to its 1x target?
Nicholas?
I can take that one. We don't want to run our balance sheet or our leverage and fund our business on equity. It's not an efficient way or manner to make use of our balance sheet. We do want to get to that one-time target. However, that does leave us with the flexibility to really identify the bolt-on acquisitions that fall within our niche area of our growth areas of data security, cloud, and DevOps. Like we've mentioned, capital light, own IP, and high annuity revenue. After the Law Trust acquisition, as well as the successful merger thereof, we will always continue to look for those potential items with an appetite of around 200 to 300 million, and possibly even one or two a year. So we'd like to make use of that ability and the flexibility within our balance sheet to really capture those opportunities.
Thank you, Nicholas. After the successful acquisition of Law Trust, what is the next big thing that Altron 2.0 has its eye on and set out to achieve in the medium term?
So Tabiso, what's the next big thing that Altron 2.0 has an eye on? Before we even become excited too much about Altron 2.0, we do need to make sure that we finalize the disposals, because those disposals are taking a significant amount of time when it comes to our management. So that is our priority. Then the next big thing is, let's use the opportunity. We can see where our customers are having challenges. We can see where we've got gaps in terms of our offerings. There's a huge opportunity in the digital transformation space. There's also another great opportunity in the fintech, in the health tech, and also in the telematic spaces. These are the areas where we are going to be doubling down and making sure that, it's exciting to see that our acquisition and our investment in Australia is continuing to pay dividends. So we would like to also double down there. Let's make sure that we continue to grow in that market. And these are the things that we have, and making sure that we take the IP that we have as a business and go and licensing in territories where those markets have got a need for our intellectual property. These are the things that are exciting for our business. These are the things that will help us to be growing the business. Our interest is to, yes, grow in South Africa through doing things and exporting our IP, but making and hiring people locally. And that, we would be excited about that, because that is going to be helping us to also address some of the social problems that are facing our country, primary of those being the youth unemployment in our country.
Thank you. Would you consider listing Netstar separately offshore, like was done with Bytes UK? And if so, what would the timelines be?
So if I can just take that one as well. It is important that we look at this business, as we have said at the end of the last financial year. We'll always look at opportunities to do value unlock. And at the right time, like we did with Bytes UK, we will do exactly whatever is required, whether it is Netstar or fintech or any other operation of ours. We will do what we believe is the right thing to unlock the value. In the case of Bytes UK, we managed to list Bytes UK in London. We will do again here, when it comes to whichever operation, we will do what we believe is the right thing for that operation. In terms of the timelines, we are not going to be talking about any timelines here. We will be looking at the environment and looking at some of the parts. If we see that there's significant gap when it comes to some of the parts and how we are trading in terms of the market, we will make those calls like we did when it came to Bytes UK.
Thank you, Mteto and Nicholas. Ladies and gentlemen, every good thing comes to an end, and that concludes our results presentation. I would like to thank you for taking the time to be here with us. You could have been anywhere else online, but you chose to be here with us. We appreciate that. Do enjoy the rest of your morning and be safe.